coming up right now on stage, that we will be looking at rethinking the VC model in Africa. Where are we now? And to moderate this beautiful panel, we have Mia, the managing partner, Future Africa. So I'd like Mia to come up on stage. Mia, a round of applause for her as she makes her way up here. And on our panel, we have Akinia Wavvenia, who's head of portfolio success, Madica VC. So a round of applause for Akinia as she also makes her way to the stage. We also have Mark Nunzi, who's the manager, capital markets, FSD Africa. Not forgetting Lindsey, who is co-founder and managing partner, Delta 40. We also have Paul, who is a co-founder and CEO, Shortlist. And last but not least, we have Ruth, managing partner and founder, Pyramida Ventures. A round of applause for that panel. And we're just focusing on rethinking the VC model in Africa. Where are we now? So we're going to see it in the order of how the screen looks like. So Mia, take over.
Have we found Ruth? Have you told her to come? Okay, she's coming. All right, cool. Okay, we get started. Welcome everybody. My name is Mia, heading Future Africa. Originally from Germany, became a Kenyan last year. Applied for my biometrics this week, so we're making progress. So maybe to kick us off, we have seen a lot of change in VC over the last 3 years. A lot of it was quite painful for all involved, but I think every pain generates new models and innovation, which is a good thing, and that's really what we want to talk about today. So why don't we do a very quick round of introduction. You don't have to talk too much about your models yet. We're going to get into that, but maybe just to kick us off and maybe to give Ruth 2 minutes to arrive.
Hello, everyone. Good morning, good morning, good morning. Thank you for gathering on this very cold day. My name is Akinia Wavvenia. I'm the head of portfolio success at Madica. We are a pre-seed agnostic fund. Beyond the fund, we also have a post-investment program, which is what I lead.
Hi, good morning, everyone. Mark Nunzi from FSD Africa. I sit within the capital market team as a manager. For those who don't know FSD Africa, we work to make financial market work for Africa. So we have different interesting departments that work quite a lot with VC and small and medium enterprises across Africa. We have an investment division, an early stage finance division, backing up quite a number of impact investors in Africa. Thank you.
Good morning, everyone. Welcome to Delta 40 and Amani Gardens. I'm Lindsey Hendler, the co-founder and managing partner of Delta 40, which is a venture studio and VC fund. And before Delta 40, I spent 10 years building a Pan-African energy company that we did take through an exit, and we built Delta 40 to really help founders on that journey of creating innovations, raising capital, and realizing exits. So really happy to be hosting and being with founders during a week that's very investor focused.
Thanks for having us.
Yeah, thanks for hosting us. Great to be here. Hi, everyone. I'm Paul. My day job is CEO and co-founder of Shortlist. We're a human capital advisory firm working across Africa. Before this, though, I started and led a global fintech VC fund and still sit on a number of ICs and have some advisory positions in the investment world here and have made almost 30 angel investments here. So sitting here kind of as a operator and investor. Great to be here.
Okay, awesome. Thanks, guys. So let's start with the fundraising side, right? Because, got to break it to you founders. Fundraising for VC is probably worse than fundraising for a startup, and I'm talking from experience. So let's start with the fundraising side, right? And I want to start with Mark, since you're sitting on the LP side. So maybe give us a little bit of a macro view, right? How is the funding landscape looking? Who is still funding the ecosystem? What are they looking to fund, and how has that changed over the last 3 years?
Great, thank you for the question. I think the funding landscape is changing drastically. I think over the last few years, we've seen a lot of changes with the development funding drastically reducing, and VCs only now doing a little bit of everything. I think us on the helpy side, we've seen VCs taking a bit more risk than they were taking before because of the reduction of the grant pool, and we've been, as FSD Africa, pushing for more inward-looking type of capital providers, who are the domestic capital providers in the capital structures of the funds that we structure and support. But having said that, as you all know, the domestic capital providers are looking for more stable revenue stream, growth level type of businesses, which often is not easy to find, especially when you're speaking to fintechs and the likes in the continent. So then becomes the importance of catalytic capital into the fund structures that we do support. And as FSD Africa, we play a very big role providing catalytic capital for the impact first-time fund managers, but at the same time also providing capital at the mezzanine tranche. So all that to say, it's an interesting dynamic. VCs are taking more risk than they were taking before. Because to be honest, some of these risks they shouldn't be taking that. We are speaking about market creation. We are speaking about early stage traction. We are speaking about product validation. So some of these risks used to be taken care of by all of this grant pool that is drastically reducing. So how do we work, all of us together, systematically to make sure that we still support the fund managers raising capital to still be able to take care of that particular section, while also bringing in VCs to do exactly what they are meant to do, while also generating revenue. So I think from a fundraising perspective, it requires us all to work together at different stages. As I mentioned, at a senior stage of our impact funds, so we are, as FSD, one of the main strategies that we guys have been looking at is to bring the domestic ones, but we also take risk at the mezzanine tranche, but at the first loss rate, I think that's where a bit more catalytic capital providers need to be on board. Yes.
So Mark, maybe just to follow up on this, so tell us what is still getting funded? You talked of what's not getting funded. Do you have to be a climate fund to get funded? Is it early stage? Is it late stage? Is it bigger sizes? And I'm asking this also because what's getting funded today is what startups will see in 3 to 4 years from now.
Yeah, I think you touched it there. Yes, today climate is a hot topic in almost all the funds. So if you're raising and you don't have a climate angle, good luck. But yes, so you need to have a climate angle, and I think for those who are interested in American investors, you see a lot of momentum around critical minerals. But again, when you speak about sectors like critical minerals, it's not all the countries where you might find businesses in that lens. So I think it's all about being a bit more creative on alignment with the donors and the investors. Who are the targets of your fund. So, and this is what I would always mention to fund managers raising or the first-time fund managers. What are the alignments, with the donors? As when you're coming to speak with FSD Africa, what are the key objectives? If you're speaking to a family office, what are the key objectives? What are the alignments? So, oftentimes we find first-time, especially fund managers, who do not really have a clear strategies on the fundraising scheme and who often speak to everybody and anyone, and you end up wasting a lot of time. So I think you need to be a little bit more targeted, because today everyone has a specific niche, and I would speak for our choir today as FSD. We are more and more looking into green, climate, and also women resilient type of activities. So when you come to speak to us, you gotta have that particular angle of alignment with the color of our funding.
So mining or climate, guys? Anything else, good luck. That's the quote, I think, we'll take away. So Lindsey, maybe start going over to you. You are raising for climate, so that's a plus. But tell us how you've experienced the fundraising landscape over the last 3 years. Have you seen major changes? Is the money really arriving? And tell us a little bit more of the color of what you're seeing.
Yeah, so at Delta 40, we always try to have very honest conversations. So I think just, Chatham House rules here. I think it's a tough fundraising climate. So I'll be honest, I think I see 3-4 years ago, you had to be a climate fund today you actually have to be careful about saying you're a climate fund or a climate company, depending on who you're talking to. So we just need to be honest about that. That has really shifted in the US. Philanthropies cannot be as open about funding climate or female gender-based things. So I just want to be very honest with you that you have to like thread the needle here. I think you need to be clear what your mission is and stay close to your mission, but I think that I actually see LPs, so LPs for the founders in the room are investors in funds. I see LPs saying we care more about commercial returns. So I think for the founders in the room, there's just one like thing that I think we all have to care about along this whole spectrum is LPs, whether they're development finance institutions, even philanthropically based funds, they want commercially viable businesses. And so that's, it used to be kind of like, hey, do you have a lot of impact and a decent kind of commercial model? Okay. Now it is, you need to be commercially viable. You need to be low risk and commercially viable. So I just think we all have to kind of absorb that, and we all have to work together to find opportunities that are commercially viable and have embedded impact in them. I think energy is absolutely a huge opportunity on this continent. Africa will be the lowest cost of levelized energy anywhere in the world in the next couple of years. So energy is big, data centers, AI, fintech, e-commerce. These are things that I think people are excited about, and I know a lot of people are building. And the last thing I'll say is I think ag is important. We all know that we need to feed, Africa can feed even the Middle East, right? Like if agriculture is big, but I find in most of the pitches we get at Delta 40, more than 50% are agriculture, but there are not a lot of agriculture follow-on investors. So this is kind of like one of the spaces that is important, but a little tough. So those are some of the things that we are seeing from the LP conversations.
Awesome. So I think what we're hearing out is a little bit, the answer depends on the type of the LP. Very Africa-focused LPs, still heavily on climate, have probably different targets to our, foreign-based LPs. And I think the second thing we're hearing out is also very much impacted by geopolitics and the situation around. So we have to be mindful of that and always think ahead of what that means for our funding, because it's unfortunately quite volatile on these fronts. So maybe Ruth, time for you to come in.
Thanks.
You can do a quick introduction while we're answering the question. But I think my question for you is, you have a bit of a different model, right? You don't have a separate fund. You're raised into the entity. So we're talking a little bit about fundraising, what we've seen, what are specific LPs for who that is a particular draw and advantage, and what are you seeing in terms of demand, in terms of investing in a model that's similar to yours?
I'm Ruth, and I run Peer Media Ventures, a venture studio model specifically focused on the agri-food sector, and also with a single entity model. So we indeed didn't raise a VC fund in our studio. What I'll say is that, it's been definitely tough fundraising, I think globally and also in Africa. And on top of that, we have an atypical structure that I would say the more institutional investors, what you call LPs maybe, but the institutional ones, it's difficult, like structure quickly closes doors, even when their mandate is, for instance, agriculture. So before we can have a discussion about value creation or logic or evidence or early evidence, the structure already forms a barrier. And I think that's because of a lack of precedent of new structures. I think, I don't know if this will be the conclusion of this panel, but there's a lot of talk obviously about alternative models to VC in capital, and agriculture probably is one of the sectors that needs alternative models. And so I'm also excited about creating that precedent, and where we found more excitement about that too is definitely with the more flexible investors like high net worth individuals, don't have ICs, family offices. They take more, they look more, I think, at your story than at immediately the structure. But also institutional investors that have an innovation or a market creation mandate. So where their mandate is to try out new models. So in our case, for instance, the Dutch Good Growth Fund, this is a Dutch DFI from the Netherlands. Their specific mandate is to test and try new financing vehicles. And so they backed us very early on And so they are creating the precedent for all of us with more innovative structures then to have easier conversations in a few years.
Awesome, that makes a lot of sense. Akinia, you want to chime in on your fundraising experience?
Sure, I will do it from the founder's end. So as I mentioned, Madica has a post-investment program. And one of the things that we're really trying to support founders with is that fundraising. And as has been shared by the panelists, like this fundraising is not just equity. It's looking at different financing instruments. And so how do you get in early on the conversation of who am I taking money from, at what stage am I taking money from them? And so this conversation of diversifying what you're raising from angels, family offices, grants that get a bad rep, but also at the earliest stages make that difference as well.
Okay, awesome. Thanks so much. So maybe let's shift gear a little bit. So we talked about fundraising, it's challenging, etc. But all of you guys have developed interesting models, right? In terms of how you have reacted and set yourself up to the challenge. And maybe Ruth, I'm throwing the ball right back at you. But tell us a little bit more about how the model works, right? And how your specific structure also impacts how you fund businesses, but also how you return capital to your investors.
Okay. So we run a venture studio model where we build in-house. So we don't, that's also why we don't have a fund. We don't invest in external ideas. And we have a stage gate approach. We focus very early on do we think this is scalable and do we think this can have an EBITDA of 20 plus? So there's a lot of things that we kill in the roughly ideation, piloting, and then we build phase. And we try like to churn out a investable company a year. So we're high touch, lower volume. So people, do you want to go into details of the structure or?
Sure.
Yeah?
Tell us a bit more, give us a bit more meat.
Okay. So investors invest in our holding company, and then I allocate that capital across our ideas. And that is both cash, because you obviously need cash to build a company towards traction so that it's investable, but also my team, my venture building team spend. So that's how we invest, and we track that very carefully. And so are there other studios? I think M Studios maybe here. This question may come up, but I think there's a narrative around venture studios being more expensive. I think Lindsey and I can talk a lot about it. And we don't think that's the case, and I think we are our raison d'être. Like, we don't have a reason to exist if we're not more capital efficient than just writing a check. And so internally, we look a lot at how much have we invested in this, and how much have we in market validation, so with an external round. And I think that's really good evidence. And in our we are very bullish on the agri-food sector for Africa. We think the fundamentals are there to be globally competitive. There's competitive labor costs. Agri-food is pretty labor intensive still. There's a very conducive climate. The land cost is better. There's a huge productivity gap that you can fill if you do it well without having to cut more trees. So like there is an economic investment case here. And then obviously it's a lot of social and environmental impact too. And on top of that, so in an investment thesis, and then it's for us the compounding pattern of building over and over and over again in this sector, we believe that gives us, or we've seen that gives us an unfair advantage.
Okay, awesome. Lindsey, you want to chime in? I'm curious to hear your perspective. Obviously, there is significant alpha to generate if you're more operationally and hands-on involved, but then your teams are naturally larger than a fund that primarily allocates capital. So how do you think about that, and also how do you think about that vis-a-vis your investors as well as your founders?
Yeah, so Delta 40 is also a venture studio, and we have the ability to build companies from scratch like Pyramid. So 30% of our fund can be used to build our own company from scratch. But one of the insights we had when we started was we built 8 companies. So you have a CEO, a chief commercial officer, talent, and then junior talent amongst those. That same team we could be used to accelerate for great founders that were already studio model. One of the biggest critiques globally, and actually one of my biggest challenges, is finding good CEOs. We build and investors who want to invest in CEO that wasn't the founder. So we think this hybrid model where you use this studio team, build large ownership, all also team to help accelerate some fantastic founders that have been, we're excited to test a couple of years, and we think it can be an efficient way to utilize. So that's a little bit of our model. I think launch our own fund, and there's two reasons we did that. One is very hard to raise enough equity into the permanent goal. We started off from a permanent capital vehicle, being very open, we raised $3 million into a permanent capital vehicle, and we could not go beyond that. The oldest investors in this space said, I will die before 20 million in imminent capital vehicle, like I will be dead. And so we realized the LPs in Africa are there. They need to go into a traditional 2 and 20 fund. Let's set up the fund and complement that with a studio that's funded in different ways. And just very honestly, that is why we did that structure. It enabled us to raise more capital for this model.
And maybe can I say one more thing on the venture studio model? There was a very interesting report launched this Monday. Lindsey was also there. The model is not replacing VC, I think, but like pipeline or for VC, more investable. And there's really interesting early evidence on this from a Brighter report. So they researched 40 studios across the continent, and they compared it to other really early stage investing models, angel syndicates, accelerators, incubators, and they all spent or invest about 250K before the first follow-on round. And studios, so 40 studios, nice N is 40, the first ticket size is 500 instead of 250. They raise a year faster, and they raise more commercial capital. So I think that says something about the alpha of this model.
Right. And I have a quick follow-up for Lindsey, and then I want to bring in Paul as the founder voice on the panel. But how are you thinking about, you talked about there's one model where we are the founder, but there's another model where we work with founders and we heavily support them, right? And I guess it raises of that tension. So in a model where you support a founder, how do you think about actually making the impact and truly influencing the path where they're going, right? Because that's also something that we think quite a lot about, because you are supporting, but you are not ultimately the founder, right?
Yes, and I'm really glad you brought that up. This is the biggest tension with studios that build with kind of, strong founders is we earn common stock for our venture studio support. So we have preferred for the fund investment, but we're like alongside of them on the common side. And in the early days, when we had a small number of ventures, they worked out of our office, we were their CFO. There was tension sometimes between the studio team and the founder, what was the right way to go. And we did make a decision about 2 years ago saying that if we are not a majority owner of the company, so we are the majority owner of the ones we build, but if we're not, we are there to support the founder. We can give them input. We are always going to give them honest feedback. But as long as they're acting with high integrity and there's a good board in place, we will take the founder's lead. We are a minority investor still. And I think that is really important because you still have to be there to empower your founder. So really, that's not all studios make that decision, but that is kind of, the decision that we've made is kind of our role. But we do try to always, we build models with them. We try to show them the data. We try to make data-driven decisions, but ultimately give that decision to the founder or the board in many cases.
Awesome, makes a lot of sense. So Paul, you've been an investor. You've been a founder for many, many years, shaping a lot of the ecosystem here. What's your reflection on how can investors be impactful? What's really working for you as a founder? What's not working? So tell us a little bit more about that.
Yeah, and I would actually probably start talk a lot about the supply side of capital. We talk a lot about what VCs want and what LPs want. I would like to talk to mostly the founders in the room. I think many of us are out there building businesses not to make VCs happy, because we care about some product and we want it into the world, jobs, we want to create local wealth, et cetera, et cetera, et cetera. All the benefits of growing small businesses, particularly in emerging economies. I think we've lost the plot a little bit. And I think we talk too much about how we're going to make investors happy and how we're going to raise money as if that's the company. Is a hell of a lot more. It's a horror to take, and it's more likely to create toxicity and kill the patient rather than make it better. And I think that the context in which venture capital is necessary are ones that don't often hold here. There is one where absolutely there are contexts where you have business models, capital intensive ones, lending businesses, have to raise it, keep raising. There are many more market dynamics, you very well might be able to slowly structure. So I don't have a creative model to pitch up here. I'd say the model I'd pitch is think profits first and see how far you can get, see how quickly you can get to that first dollar. Shortlist is a good example. We started thinking we wanted to be a VC drug addict. We were addicted for the first several years. We enjoyed burning tens of thousands of dollars a month, every month. It was amazing. And I think it was COVID that just kind of slapped us in the face and was like, wait, what problem did we set out to solve? It was a problem around could have did it. Not with a proxy solve all the problems you need. And studios are great examples of that there's often a set of talent and skills and expertise and connections and intellectual assets and whatnot they need to grow. And when we talk about, when we're at these conferences, I feel like we're always talking about money. And I think I just keep thinking of us, we've all got this hammer, and so we're just looking for nails, and we're ignoring all of the places where a different screw or fastener or whatever is needed. So I do think I'm thinking critically as founders about, do you really need to raise? Are there other pathways to get there? Do. So that will in and justify investments. Don't in Africa is generally second, third, fourth movers, almost usually win more. Moving slowly, focused on quality and relationships and reputation, almost always rewards you more than kind of going quick and burning your first hundreds of customers. And I do think if you need money, I do think like trying to cultivate more strategic funders, corporate funders, high net worths or angels who might be looking at criteria or passion areas or other areas aren't just about returns, and whose exit may match with you. And the thing I keep thinking about with Shortlist is we became profitable in 2021. We're standing on our own 2 feet. I thought, even as an ex-investor, I thought my investors will be happy. Do a dividend, and my investors were unhappy. What business model in the world as an investor where we're going to give you free money, just tell us where to send the check, and you're unhappy? You know something is wrong and might be in conflict with how you want to build a business. So the question I'd ask as entrepreneurs is, what is the best version of your business, and what do you need to get there? And as folks who want to support the ecosystem, investors or others, what do these companies really need to succeed? Sometimes it's money. Often it's money in a different form than VC, and oftentimes it's more than just the money. It's the human capital, it's the connections, it's the expertise, it's the IP, et cetera, et cetera.
Thanks so much, Paul. I want to bring it back to Mark. Please, applause. Please find Paul after to get more real experiences from him as a founder. I'm sure it will be very valuable. Want to bring it back to you, Mark. You talked about this a little bit at the beginning, but the reality is that here, Paul said that VC is often seen as the only way to fund, and VC often funds a lot of early innovation that in more developed markets a university would fund, a government grant would fund, right? There's a lot of funding for, real innovation that might not have a very clear commercialization path yet, right? But here, often, VC is seen as the way, and VC is funding a lot of that, right? And the returns are naturally maybe not as great as they are supposed to be. So how are you guys thinking about that from a sort of DFI development perspective? How can you actually, catalyze more funding into sort of de-risking this really pure innovations at earlier stages?
Great. I think what we do creatively as FSD is that we look at ourselves as market builders, right? Rather than just looking at ourselves from an investment arm. As I mentioned at the beginning, we have an early stage finance division that works with a lot of VCs, but we also look at possibilities on growing them from just moving from VCs, first-time fund managers, to the second fund managers, and being able to grow along the same pace with these businesses. And to the problems mentioned on the funds, on the demand side of capital, when you look at all the funds, majority of the funds that we are setting up today, we have an element of technical assistance that comes in on the demand side of capital to come and strengthen capacities on that particular areas. Because as mentioned, yes, I think quite a lot of LPs today, you would speak about them, especially if you're a GP, first fund managers, your fund economics would be, I would say, one of the main points of conversations. And sometimes this gets tiring, as mentioned by Paul, sitting there speaking about the funding and the money. But we want to make sure that we build the next unicorn of Africa. So it has to go across the whole spectrum, the whole full value chain of raising capital, from VC to first-time fund to the second fund managers. And that's why, what I said in the beginning, for us to bring in some of the domestic capital providers that we see in Africa, it takes a lot of time, right? So, but we are supporting these GPs with that vision to bring in at the senior stage of the capital structure this pool of capital that is patient and is able to support most of the businesses that we have in Africa. So all that's to say, whatever we guys are providing as support doesn't only come with the money, but it comes also with the technical assistance, but also the de-risking, I would say, mechanism that these structure needs to raise capital, such as guarantees, for example. So for some of the GPs in the room, I think one of the main advice I would give is whenever setting up your fund and coming to speak to some of the LPs, what are some of the guarantee schemes that you're putting in place to be able to give us a bit more comfort? And as market conveners and builders, what we do is to help some of the GPs to come with this whole structure that is very well catalytic for senior capital providers to come in place.
Okay, and for you guys, you're channeling this exclusively through GPs, or is there also other ways you're channeling this?
Yeah, most of the model that we have worked on is to channel to GPs. We don't manage the funds, so the way we would set up a fund is we would kick off. I'm speaking from a catalytic transaction perspective, which sits within our capital market. We'll kick off with a feasibility study on the demand side of capital to see if there is pipeline, if there's value addition, if there is really business sense for some of these funds that we want to make. But at the same time, we'll also look at the supply side of capital, because we won't bring in all the capital into the fund. So who's interested to come alongside with us? Because as I said, we come quite often at the first loss, but also at the mezzanine tranche with our investment division. But we want to make sure that we are not the only one funding through the GP capital structure. So once we look at the demand side, we look at the supply side of capital, and we see there is, I would say, momentum there, then we set up a call of expression of interest to bring in the fund managers to come in to mobilize more capital with us, then to do the deployment. So we don't manage ourselves, but we do deployment through fund managers. Yes.
Okay, got it. Akinia, maybe on your side, I know you guys are very early stage, but you also have an associated fund that is a little bit later stage. So how are you thinking through sort of moving your companies through the stages and then ultimately thinking about exit as well?
That's a great question, and I think it ties a lot to not only conversations on this panel, but previous panels of, number one, being able to enter and from the founder perspective, think about what type of business you want to build, number one, because that will direct who you get your money from. but also thinking of that pathway of profitability, whether that's, I'm going to build a business without venture capital or any other type of capital, or outside of that. But I really think as it comes to supporting these companies as we are very early stage, one of the best things about the way we've structured the fund and the post-investment program is that we only invest in the pre-seed stage, which means that and as far as our relationship with founders is concerned, they can be as transparent with us as possible because we're not going to give them additional money. So that really ensures that, number one, the first thing that we're doing is deploying capital into those companies, and then over the across 18-month period, trying to de-risk their businesses in various aspects. And so when it comes to finding pathways for that alternative or additional capital, it's trying to figure out, okay, does this business model make sense just for VC? Are there other opportunities for you to essentially grow your business outside of this bubble that is VC? Are there other opportunities as you're looking at potential exits for you to think about, okay, how do you get strategic partnerships now, for instance, with corporates, even if you're early on? So I think it's trying to walk with founders through that journey to try to essentially think ahead of what that's going to be, but also help them prepare effectively for what their seed is just going to look like. I think the reality of being a startup in Africa and raising in this climate is that the expectations are really high, even for a pre-seed company. And so by the time you're even speaking to a lot of investors at this stage, it's like, what does your data room look like? And it's like, I don't have traction. I'm pre-revenue. How do you expect me to have this at this stage? But those are just the expectations of being in this market. So it's getting ahead of that curve and preparing founders for those conversations, even at the seed stage. So what are the fundamentals, at least from a fundraising perspective, that we can essentially de-risk and prepare for now in order that the companies, by the time they're exiting the 18-month program, are able to successfully raise those additional amounts that they're seeking.
Awesome, makes a lot of sense. So I think we have covered a lot of ground across all of us, very many different aspects. So maybe let's open it up to questions. Let me know. Okay, well, the gentleman in the back was first. Please stand up, tell us who you are, and then we go for it.
Hello, my name is Winosa. I work with me at Future Africa. I'm the investment manager at the fund. So I wanted to talk about, I guess, to everybody on the panel, and echoing what Paul said. I think, at least from my time working with me and Future Africa and all the various investments that we have made have led to good outcomes, that venture is more of an outcome than an asset class. To be more specific, we find ourselves wanting to build unicorns, whereas I think there's an article that came out recently that we need more zebras than unicorns. I feel like the VC fund model is trying to make zebras into unicorns. So for instance, we see unicorns today that are frankly overvalued, and we have all gotten a good venture outcome from building and investing in these businesses. But now the businesses are struggling. I don't need to say the name, but we know that some businesses are now struggling to now justify that valuation. Do you think that we, as VC investors, we have created a cycle where we're not going to truly build great businesses?
I can also start because I'm holding a mic. Yes, I think we are creating a problem, and whether you call them zebras or elephants or ants or camels, or I think there's like 3 or 4 other terms, I think we're force-fitting companies that want to be profitable, stable, growing businesses and force-fitting them into a unicorn template that doesn't work. I mean, in my own fundraising journey, I remember the only way I could raise VC money was to create an alter ego. My alter ego was named Travis. This was the age of Uber. And Travis was a cocky bastard. I knew everything. I was going to crush all comers, all competition. My natural personality, if someone asked me, I'm kind of a lawyer by training. If someone asks me a question, I'm like, well, yeah, it could be this, it could be that. We should probably learn more. When I was Travis, it's like, no, it's this. We're going to crush it. It's done. when you find that people who would be good leaders and would build good companies have to make up identities in order to fit, like, I think we're in the wrong area. And I think that VC makes us take risks that you probably wouldn't want to take if it was just your own company. You are trading, you are getting, you are getting the sugar high of money. You're getting the sugar high of being able to afford what you want to afford and pay yourself a salary in the short term. But you're trading a lot of outcomes that would make you happy. You might be thrilled to wholly own a business you sell for $10 million. Your VC will probably not be happy if you sell a business for $10 million. You might be thrilled to do $1 million EBITDA a year. Your VC probably won't like that outcome. So I think those are misses.
No, and I love how, I'm so glad to know that that was an alter ego that I saw sometimes, because I love the new Paul. But no, I mean, first of all, thanks for being so honest, but I do want to kind of think a little bit about solutions here, because like what I agree with Paul, and I think we should actually be honest. We talk about VC, we're equity funds. Let's be honest, we're equity funds. We call ourselves VC because there's no other thing to call us, but we all know that there's like, we don't have the same VC trajectory as Silicon Valley. So I think we should even think about renaming this to early stage equity, because that's what we are. And we need to work with LPs. See, the problem is we're having this conversation without the LPs. The LPs need to hear what Paul is saying. But okay, but what are the solutions? Because I will say, I had a good experience with VC, and I just want to make sure this is out there. And I think that I built my last company in Uganda. I was based, so I wasn't around all these VCs all the time. I was very focused. We were very lean. We had a very low cost base. We did not raise that much equity. And all of my VCs were former entrepreneurs. So my Series A lead and my Series B lead were venture capitalists. They wanted a big return, but they were entrepreneurs. They were not institutions. They were not backed by DFIs. And they sat at the table with me on my board, and they pushed me to be a good entrepreneur. And we did not raise that much VC. So one of the solutions I want to put out there is, along the VC we raised a lot of debt. Our first loan was from Silicon Valley Bank. We need early stage debt that allows us to buy inventory. So climate companies here on Climate Day, you cannot most normal people who are not independently wealthy cannot bootstrap a climate company. So it's like, we can't just say, oh, let's not raise money, let's build it ourselves. We're only going to have independently wealthy people building companies. So how do passionate entrepreneurs build a company? My view is, take a little bit of venture capital, because that allows you to take risk and innovate. And we all need to take risks. But do it from the right people and complement that with grant and debt. And I just want to say one thing on the stage today. I hear people talking about how grants are going away completely, how grants are bad. Companies that take grants. I had investors say, I don't look at companies that have taken a grant. I think that is ridiculous. In America, the most innovative country on earth, where there's tons of commercial capital, the most innovative companies raise a lot of grants. We should be raising grants, we should be deploying grants, we should be looking to create pools of grants to stimulate innovation in underrepresented founders, period. Then we should come in with commercial capital and push them to be sustainable and have sustainable unit economics. And then we need debt. So the reason the companies get into these problems of the valuations being too big, in my view, is because they're building the whole company with equity. So if you raise 10 million of equity, you have to be valued at 40 million. I mean, there's just the math doesn't work any other way, even if you have no revenue. So let's really think about, as a solution, how does equity work with grant and debt together? How do we collaborate to create the right capital stacks? But I want to make sure we don't move away from don't raise any money, because we need African founders to raise meaningful money. I hate seeing all the well-funded companies be foreigners, and all the African companies don't have significant capital. So it's not if, it's how to raise the right money. And I will say, this afternoon, Delta 40 is hosting a debt roundtable. We're equity investors. Why do we do a roundtable? Because we want debt to come in early. It needs to be part of the stack. So I think just let's hear some more solutions. Like, what are new ideas? Revenue sharing, equity tools. There's lots of new things we could do, but I would really love to move this to, like, what are the new tools we should use instead of the VC capital we were addicted to 10 years ago?
Absolutely. I know there's 2 more questions. Go for it.
Good afternoon. My name is Laban Bore. I'm the co-founder of a company called Data Pulse Africa. and I'm managing director of a company called Kalaro Farm. So at Kalaro Farm, we support agri-SMEs, the last mile farmer in Uasin Gishu and Baringo County. Yeah, so out of curiosity, I was trying to think what's the dynamics of supply-demand dynamics around capital. Do you see a situation whereby there's quite a supply of capital and you don't have quality deals at the table? What do you do in such kinds of instance? Now, flipping it the other side down, you have quite a lot of deals coming in and then there's very little capital coming in. So how do you balance those kinds of dynamics? Number two, yeah, it's very hard raising. I've been trying to support, it's very hard raising capital, especially for the last mile farmer there. In case you cut this, now there are those who are unable to reach the finish line. How do you deal with these founders? Do you refer them to an investor somewhere, or
and if I am not the right funder, maybe, where can I send a founder where they
you would see any DFI in the room, number of them must exit. Where in Africa, we are unable to recycle capital and give the opportunity to investors to go to other type of assets that is available out there. So one of the most innovative way that we come up with a secondary type vehicle where we will be able to facilitate exit of some of the very good assets where we are quite sure that on the domestic capital side, these assets could be able to be managed and have new investors such as pension funds. So yes, we speak about the type of asset, we speak about the exit, the private equity problem. What you have to keep in mind on the supply side of capital, especially equity, all investors would want to see an exit angle, right, before they put the money at the table. We are trying to solve this problem for Southern Africa, especially we are kicking off in Kenya with an interesting roundtable yesterday with pension funds, fund managers with very good assets, and all of them have assets. Some of them are generating X million type of money, but they can't exit those because there's a liquidity problem in the market. So you might list even in the Nairobi Stock Exchange, but having the possibility to mobilize all this capital is a challenge. So all that's to say, yes, solutions are being rough on the supply side of capital, and I'll let my other colleagues to maybe speak about the how to address your question on the demand side.
Where to go when you can't find money? $1 million question. If you answer it or if you figure it out, let us know. But in all seriousness, when it comes to raising, I think there's a couple of things. And I'm just speaking about like a portfolio management end of things. I think the first thing is trying to figure out, are you getting money from the right people? Yeah, and so is your business model matching who you're speaking to? Because again, the trap of VC is if VC is your earliest money that you get, you end up thinking within that realm and lens. And so as you continue talking to VC funds and investors, they will block you out because maybe your model is not VC. So I think the first question is, number one, what business model do you have? And does it match the investor that you're speaking to? I think also beyond just trying to understand that, it's also your narrative. Maybe you do have a VC backable model, but the way you're communicating this doesn't make sense. So I would say, and this goes back to a lot of the conversations that have happened today, be able to sense check, yeah? Be able to sense check within your founders group, be able to sense check within your investor list or investor friends of, does this narrative make sense? Does it sound fundable? Do my numbers make sense? So the story that I'm saying as I'm speaking to you and I'm pitching, does this match with what your financial model is saying? Does this match with what your projections are saying? So I think especially at the earliest stages, a lot of it is incoherence in your storytelling when it comes to what you're actually saying versus what your numbers are saying versus what your revenue shows. So I think it's taking a step back to understand, am I communicating a seamless story, number one? And then number two, am I speaking to the right people?
Thank you all so much. It was a very open, honest, and passionate conversation. And if you as founders should take anything away, is that even your investors have different ways. They are pivoting, they're trying different models, they're also fundraising. So we're all in the same boat trying to move us all up. So with that, we hope we have a great rest of the conference.
Yeah. Thank you so much, Mia, and your wonderful panel.